Hi guys, a very good morning to everyone again. Zikin here. This is the Seminar 2 recording for the tutorial 2. And again, if the previous video did help you, I hope that this video would as well. And again, I do not claim any credits for the questions that I will be solving here today. They are all from NTU. So if I do make any mistakes in my solutions, do let me know in the comments. And let's get started with the first question. And for the first question, we are told that we have to label the different violation of the transactions and the correct accounting treatment for each transaction. So let's take a look at the first transaction. And what we're told is that John bought a car, paying from the company's bank account, but recorded this transaction with as the company's fixed asset. And that is erroneous, right? Because John bought the car for his own usage and not for the company's usage. So here we would label this as a violation of the accounting entity concept. So the accounting entity concept tells us that the company is a separate entity itself, a separate entity from the owner, assuming that it's not a sole proprietary ship, right? So I'm going to make that assumption, and that is why the John's personal purchases should not be included in the company's transactions or nor in the company's balance sheet. And the correct accounting treatment would be that this transaction is not recorded in the company's fixed asset. So we will not record this. So to treat each John and the company as a separate entity itself. For question two, we have ABC company purchasing a building for 9 million in 2020, right? And there was appreciation of the building, and now it is 11 million. So there's an increase in the asset. And the company recorded the increase in the value of the building uh, and added this increase to the P&L. So we know that this is erroneous, and the violation would be the historical cost concept. So what the historical cost concept tells us is that your asset should be recorded at cost on purchase. And should there be an appreciation, you do not just simply recycle this increase in value to your P&L. So yeah, the cost to be okay. What they did here was they tried to record the cost at market value rather than the historical cost of purchase. So number three, the XYZ company recorded its transactions based on cash flow. So I mean, at least for this module, we use accrual accounting and not cash-based accounting. So this is cash-based accounting. Right. Meaning you record based on the cash transactions rather than on an accrual basis. So an accrual basis would be to recognize the revenue or cost when incurred, uh, regardless of whether cash was transacted at that point in time. And so we can say that there's a violation of the accrual basis. Um, so the next question here is, does cash-based accounting match the expenses for that time period? So say, for example, you received a cash payment from your customer 1 month in advance, and the service would be be rendered in the following month. In that case, would you then record the revenue, or will you record the cost for that revenue that you gain. So in cash-based accounting, it's very difficult to keep track of that, right? Because it's very difficult to match because you only record when you incur a cash transaction. Whereas for accrual basis accounting, you would recognize this early payment as an unearned revenue, and then to recognize the expense for providing this revenue only when that revenue has been incurred. So in some sense, the matching principle here is also violated because you cannot simply just match the cash expense simply just like that unless you did incur it in the same time period. So which is why the matching principle is violated. And the correct accounting treatment would be just to record based on the accrual basis, right? So to to follow C, and that will allow you to also then accurately match your revenue to your costs. So that will be for the question one of the seminar. I hope I was clear in my explanation and my train of thought. So for the second question, we are given a company's trial balance sheet, right? And we are told that some customers pay in advance for services, so those would be categorized as unearned revenue because you obtain cash in advance and you have a liability to provide this service afterwards. We are also told that advance payments are credited to unearned fees. So instead of unearned revenue, we would call it unearned fees in this question. We have adjusting entries on a monthly basis. Okay, and we are given a trial balance for 31st December, and adjustments has already been made for the first 11 months, but not for December. So we only need to be concerned of the December entry in this question. And maybe just before we start the question, we want to go through what's an adjusting entry. So the adjusting entry would be to match the revenue earned or the expenses incurred for that time period, such that you're going to adjust a certain line item to more accurately reflect what has occurred in the company. Right. And we want to see for the question. So for each of the numbered paragraph, prepare the necessary adjusting entry. So the numbered paragraphs is below here, and we will go through them sequentially to solve for this question. So we are supposed to make adjustments for each of the additional information. So the first information given was records show that 2.5 thousand of cash receipts recorded as unearned fees has been earned as of 31st December 2022. So there is an decrease in unearned revenue, and this decrease in unearned revenue will now be then credited as actual revenue. So we need to make this adjustment, meaning we have to find the unearned revenue entry, unearned fees, and we need to decrease the unearned fees by 2.5. So 2.5. And we need to then increase the revenue for the month, uh, which would be which is not here in the trial balance. So that would be our first adjustment. Note that we will not be adjusting cash because cash has already been received then. So if we cannot find the revenue, then what we would do is we would then increase the retained earnings because we know that the revenue falls under the owner's equity, and if there's no revenue to be matched here, then we would simply just increase the retained earnings component here. Okay. Um. So let's carry on. For number two, the company purchased a 6 months insurance policy on the 1st of September for 1.8 thousand. Okay. And that would mean that we have to divide the 1.8 thousand by 6 months to find out how much we need to expense on a monthly basis. Right. And we know that 1.8 over 6 would be 300 per month, right? So we need to expense off this insurance policy by 300 every month. And when you purchase a 6 months insurance policy, meaning you pay all cash upfront, this would be considered as a prepaid insurance. So we would be able to find it as an asset here, the prepaid insurance here, right? And we need to decrease this prepaid insurance by 300. So we need to minus 300 here, and that will net us 600 as the final value. So we will expense it for the month of December. And when we expense, because we deducted the asset by 300, we should increase the expense by 300. So there will be an insurance expense, which we will have to add. Oh, sorry, insurance expense here, 300 too. And that will give you 3280 as the final value. So remember, assets is equal to liabilities plus owner's equity. When you decrease the asset, you would have to decrease the right-hand side of the equation. So that would fall under the expense component, and the expense component will fall under the owner's equity. Moving on to question 3, the company paid its rent for 1st of December 2002 to February for $9,000. So that would be a total of 3 months, right? So we have um, 3 months, and that would mean that it's 3.3 thousand per month, right? So we would expect that there's a prepaid rent of 9,900 because no adjustments has been made, and we need to expense off 3,300 under the rent expense. So let's take a look. There will be a prepaid rent. Okay. There's no prepaid rent. So we see that there's a rent expense here, and there's an error here because this rent expense should not be 990, rather it should be 3300, right? And we should have an additional entry here as prepaid rent. So we will insert an entry, prepaid rent, and we would debit a value of 6600 here. So again, because this entry is wrong, so we have to correct this entry, and this should be the correct adjustments. All right. Moving on to question 4. The office supplies on hand was 31st December amounted to 400. So we are told the final value, and we need to find out where the office supplies are. So the office supply right now is 600. To make it 400, we have to simply deduct it by 200. And we deduct the asset, we are actually expensing it off. So we need to increase the office supply expense by 200. And that will give us 980. Okay. So we are done with 4 as well. So all equipments purchased on when 1st of December, oh sorry, all equipment was purchased when the business first formed. The estimated life of the equipment was 10 years or 120 months with no residual value. So when you purchase the equipment, recall, even in question 1, we record the equipment at cost, right? The historical cost in which it was purchased in. And the equipment here is 60,000. So we know that the depreciation of the equipment, so the depreciation on a yearly basis would be equal to the 60,000 over the 120 months, right? And that should give you 500 per year. Sorry, 500 per month, because we are dividing by the month. So we will have to increase the accumulated depreciation for $500, and we need to recognize that depreciation expense of 500. So this would be 6,000, and we know we have to add 500 here as well, and this will become 30,000. So note that accumulated depreciation is a contra asset. A contra asset to equipment, meaning to increase the contra asset, you would have to credit it. It's essentially the signs are reversed from your normal asset. Okay, and then we're done with the fifth point. So for the number six, the company borrowed 12,000, signing a 6 months 8% note payable. And the 6 months in accrued interest is due on 1st of February. So it means that you will not need to pay this not payable until the 1st of February. So when you borrow 12,000, I'm going to assume that this is a simple interest calculation because this is what we are told to do in the course. So to maintain consistency, we want to find out what is the interest per month and TH. So we have 12,000, right? And we want to find out at 8%. We want to find out for each month, 12 months, and this will be the interest expense for each month. So to calculate this value, I believe this value should be 80 per month. Do correct me if I'm wrong because I recorded this value down a while ago with a calculator, so I hope I punch in the correct numbers. And indeed, if this is 80 per month, then we would have to expense off this interest expense, right? So we increase this by 80, which will give us 400 in value, right? And we also need to increase the interest payable that we have to pay, right? Because again, asset equal liabilities plus owner's equity, you have to make a corresponding entry on the other side to the credit. So the interest payable would also increase by 80, right? And that will give you your 400. Right. And the last point, estimated income tax totaled 15,000. Taxes are due on the 31st. So right now, for the financial year, it totals 15,000. So as of the 1st of December, it's 12,000. We need to increase this by 3,000. And this will give us the 15,000 final value. And we should have a tax payable, income tax payable. So we need to increase this by 3,000 as well. And this will give us the 7,000 value. And with this, we have made the corresponding adjusting entries for each of the numbered paragraph. So to determine the amount at which each of the following accounts will be reported for the fees earned. So for the fees earned, sorry. So that was where I made a mistake here. Your retained earnings should not increase. The fees earned is this. So I was trying to look for revenue rather than fees, and I missed that out. So fees earned would increase by 2.5. So the final value would just be the sum of this. So 75,000 plus 2.5. It will give you 7.5 thousand. For your insurance expense, so insurance expense we have addition of 300, right? So this would be the final value 3280. 3280. Okay. Um, and for the rent expense, we have an addition, or rather, we have mistaken entry here by the accountant. So the correct rent expense would be 3300. Okay. We also have the office supply expense, which we know is 200 for adjusting entry, but we also need to find out the office expense for the other 11 months. And the office expense would be down here, 980. So 980 depreciation expense. So the depreciation expense for the year would be here, 6,000. Interest expense. So here we added the 80, so we get 400. Income tax expense, we know that that will be 15,000 because in fact we were given here the expense total 15,000. So how many years has the equipment been in use as of the 31st December 2022? Okay. Um, so to find out how many years the equipment has been used, we have at the equipment at cost. And remember that accumulated depreciation is a contra asset. So we have the depreciation, right? And the net of this is the book value of the equipment, right? Meaning the essentially the remaining value, the useful value of the equipment that would provide some economic gain or benefit. And we know that the equipment is bought at 60,000 and the accumulated depreciation is 30,000. So we have the net as 60K minus 30K, which gives you 30K, right? And it's very easy to see that your accumulated depreciation is equal to your book value of the equipment, meaning you have already used up 50, you have used up 50% of the of total life. Okay. And if the equipment has 10 years, which was stated here, so the total life is 10 years. And if you use up 50% of your total life, it means you have as 5 years. Alternatively, what you could do is you take the remaining, or rather, we can take rather than using remaining, we can just take the book value over the equipment costs, so recorded at cost, times the 10 year. And you should also get the 5 years. So note the book value is 30,000, and the equipment recorded at cost would be 60,000. And you would still get back the same number of years in both cases. So I hope that the whole solutions that I gave was clear. Again, if I do make any mistakes, do let me know, and I will correct it accordingly. So thank you for your time today. Goodbye.